Coming up on today's show, stocks making a huge bounce off the lows, but can we trust it, or is this just a dead cat bounce? My thoughts on CPI and why I believe the market is wrong, why this stock was down 20%, and why BofA believes we're getting rate hikes this year. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks were mixed on Monday with big tech names sliding as the dollar and bond yield continued their climb amid fading hopes for interest rate cuts ahead of this week's consumer inflation report. That is the CPI. The big boys led the market lower today. Look at Tesla, look at Eli Lilly, Walmart, Visa, Costco, Meta, some of the big tech names, Microsoft, Google, Apple, and Nvidia. All of these names, the big boys, these richly valued mega cap companies all slid while the broader market actually gained. And it was very mixed price action under the hood. It was a little bit of a bounce back after Friday's price action, as well as a bounce after some of the earnings that we did get today, as well as just a bit of pricing concerns with regards to interest rates. There's concerns about that moving higher. There's concerns about tariffs, and all of this led today to the price action we saw today, where we actually did see the broader market in the green in a very big way and the mega cap names taking it on the chin. Nonetheless though, more sectors gained than lost, and the S&P 500 was actually flat, down 0.07% today. The Dow Jones was actually up 0.7% today. So the broader market really rallying, with the best performing sector being XLE. Energy continues its rally here in 2024, and that's because the US imposed tougher sanctions on Russia's crude industry, threatening supply to China and India. As a result, crude was at $80 a barrel. Energy stocks as a whole were up 2% to kick the week off. Materials also caught a bid. So too did healthcare, industrials. They were all up in excess of 1%. We also saw financial staples and the discretionary space gain. The SPY was flat, as I mentioned, and XLC, the communications sector, the technology sector, and the utility sector. So anything geared towards AI or the richly valued tech sector was down today, with XLK, the technology sector, and utilities both down in excess of 1%. And you can see that pretty much every sector started the day off here in the red. We took a pretty big slide, and then we pretty much made higher highs, higher lows to finish the day off in the green for the average sector. Nonetheless, because large cap growth was the worst performing factor and size segment today, this includes Nvidia, Broadcom, Apple, Microsoft. Because these names were in the red, the market as a whole was kind of flat today. We also saw large cap core was down 0.07%, and growth as a whole took it really on the chin. But then when we look at small cap, mid cap core right here, right, and we look at small cap value, mid cap value, large cap value, they really held up the market. And this is stuff like energy stocks, healthcare stocks, industrial stocks, real estate stocks. These names did really, really well today, despite a rising dollar and rising yield. And again, it was somewhat of a bounce back, as well as some of the market dynamics we saw today. Nonetheless, the US was red, the global market was red, Europe was red, Asia as a whole was in the red as well. Southeast Asia, the semiconductor belt of the market, India, China, on the back of some of the geopolitical tension. Australia was very red. In fact, the only green geography we saw was parts of South America. That was pretty much it. And there wasn't much in the way of economic data. We really just got consumer inflation expectations. The reported figure was 3%. The forecast was for 3.1%. So that's somewhat a positive, but this is less important than the CPI data, the consumer price index data we get tomorrow. Tomorrow we get the PPI. The day after tomorrow we get the CPI. But let's actually talk about some market movers. Moderna was down 20% 8%. This is such a volatile stock after the biotech giant cut its 2025 sales forecast by $1 billion amid soft demand for vaccines. If you're going to cut guidance, you're going to get this in your price action. It just goes to show how richly valued some of these stocks are right now. With where valuations are, guys, if we get guidance cuts, earnings season and stocks are not going to bode very, very well. Now, in terms of earnings today, Shake Shack posted preliminary fourth quarter results. Now, they beat expectations on the top line and bottom line. However, investors didn't really like some of their international plans. The stock was down 6.5%, and this was on the back of a 15% year-over-year revenue increase. So again, it goes to show evaluation and what guidance is going to look like. That's going to be the focus for this earnings season, not necessarily what last quarter's results were. Now, looking at some market movers in the green, United States Steel, ticker symbol X, jumped following news of reports that rivals Cleveland-Cliffs and Nucor are considering making a joint bid for the iconic steelmaker just weeks after the Biden administration blocked a takeover of the Pittsburgh-based company by Japan's Nippon Steel. As a part of the offer, Cleveland-Cliffs would buy U.S. Steel in cash and then sell the company's Big River Steel mill in Arkansas to Nucor. Cleveland-Cliffs reportedly offers less than $40 a share to buy Nippon Steel. That's far less than the $55 per share Nippon Steel had offered to pay for the company last year before the Biden administration blocked the merger, citing national and security concerns. The stock was up 6% today, but there's not much upside left if this acquisition by Cleveland-Cliffs goes through at $40 a share. Nonetheless, investors like this news, and it's a good thing for U.S. Steel because they really need this merger to go through to protect these jobs and keep their business moving. And shares of United Health rose 4% Monday, helping lift the Dow Jones. United Health, along with other insurers like Humana, rose after Medicare released a proposal that would allow for bigger than expected payments for insurance companies in 2026. And United Health was up 4%. And this is probably going to be a tailwind for these stocks because they've been absolutely hammered in the last 3 to 6 months. But for everything we saw today, guys, we did actually see more decliners than we actually did see advances. And a lot of these decliners were some of the big names, the mega cap names. Nonetheless, we are starting to see slight improvements in overall market breadth, especially when we look at the nuances in the moving averages. You can see a slight improvement here in the 200-day, the 150-day, the 100-day, the 50-day, the 20-day as well, and the 5-day. This is very, very solid and exactly what you want to see if the market wants to try put in a bottom. Nonetheless, we are still well below the 50% level that you kind of want to be above across all of these moving averages. And until we actually start retaking like the 50-day moving average right here, as well as the 20-day, that's when I would really start to see bullish momentum continue. But until that actually happens, until we actually see the 50% mark retaken in these shorter term moving averages, expect continued volatility in large caps and small caps across the board. And diving into the charts, guys, you can see kind of mixed price action here in equities. The S&P 500 flat, same with the IWM. The RSP up 0.61%, the Nasdaq down 0.65%. But this doesn't show the price action we actually saw today. Stocks were actually very, very volatile. If we actually just go on the one-day chart, this is the S&P 500, and we just go on a percentage return basis. You can see that the S&P 500 is virtually flat, but to kick the day off, we were down as much as 0.88%. If we go to the Nasdaq 100, you can see we were down at one point as much as 1.5%. So we did actually somewhat put a bottom in very, very early in a lot of these names, stuff like the Nasdaq 100, as well as the S&P 500. And in large part, the reason why that actually happened had to do with the movement in yields. Yields caught a bid the dollar caught a bit, and that really affected equities early on. However, stocks put in a low, and we actually did see stuff like the RSP in green territory, the Dow Jones in green territory as well. But some of these riskier assets, stuff like the Nasdaq 100, stuff like Bitcoin, both down in the red. Gold and silver were down significantly, and that's because if you look at the 10-year yield, look at the 30-year yield, offering a 5% yield. When bonds and cash are offering that type of a yield, it becomes a real competitor to stuff like commodities. However, crude was up 2.78%, but there was some news behind that. The Biden administration and natural gas was down 1.9%. But regardless of the bounce we actually saw on the day, equities are red today, especially the S&P 500, on the back of the torturous day we saw on Friday. And we actually did see the gamma levels move down. We saw the core resistance, the gamma flip zone, and the put support all move down in all three, the S&P 500, the Nasdaq 100, and the RTY. So we saw those levels move down in all of them. And for those of you that don't know, this is the gamma flip zone right here. Above the gamma flip, we are in positive gamma, and dealers hedge their portfolios. Options dealers hedge their portfolios by selling into strength and buying into weakness. When we are in negative gamma, dealers hedge their portfolios in the opposite way. They buy into strength, sell into weakness. And that's why in negative gamma, you get this very volatile price action. And in positive gamma, you get very orderly price action, a stair step higher. And that's kind of what we see. If you have a look right here in positive gamma, you see like this stair step higher, right? Negative gamma, you get this very like brass price action that goes up and goes down. Nonetheless, we are in negative gamma, and look what we did. We bounced right off the put support zone in the S&P 500. So that level is the 5780 level. It's actually the exact level where we had the Trump gap up. This is when the markets realized Trump was going to win the election. Stocks as a whole gapped up, and then we traded along this line right here. However, we broke that line last week, and now we are trying to put in a bottom for the S&P 500. And you can see the S&P 500 going green. Do be aware, guys, the market is still open for a good couple of minutes. Nonetheless, market's kind of flat. The Nasdaq 100 red on the day, and we did see some not great price action in the options market. The Nasdaq 100, very similar situation, didn't quite bounce off the gamma flip, but still looking to put in a low right here. But the move up wasn't as strong in something like the S&P 500, the IWM, or the RSP. And these stocks are really moving into the close right now. The IWM up 0.16%. Let's go to the RTY. You can see we didn't quite get to the put support as well, but we did put in a very big wick, and we are making a move to the upside right here. Looking at the RSP, up 0.78%. Stocks trying to recover off these lows. What stocks need to do now is see follow through. If stocks can follow through from these levels to the gamma flip, that would be positive. Then sometime later this week, if it coincides with a consensus CPI print, we can then make the move onward and upward into positive gamma, and we can look for some of these higher highs. And this will likely be the bottom here for January. However, if stocks don't make it up to the gamma flip or use the gamma flip as resistance on the back of maybe weaker than expected CPI data, that's going to not bode well, and this will probably look like a dead cat bounce. So if you're a bull, you really do want to see follow through from these lows. However, if you're a bear, there's still a lot of room to work with. And what you're really waiting for is a weak CPI print and a weak PPI print tomorrow and Wednesday. So it's all going to come down to the data. The market's obviously just bouncing here because, market's looking a little bit oversold. I think dip buyers are coming in on a peak to trough basis. We're looking at a 5.25% drawdown. Generally speaking, most people would start buying here at a 5% pullback, then a 10%, then a 15% pullback. So this looks like a great position to probably start buying. That's what dip buyers are doing, along with some of the news. And heading into earnings season, it's going to be a strong earnings season. So the market looking at that and just trying to reprice that risk as a whole. Nonetheless, it doesn't really matter what stocks do today. What really matters is PPI tomorrow. If we miss the PPI numbers, that's not going to bode well for the CPI numbers, and the stock market is going to sell off. If we get a hot PPI and a hot CPI, expect yields to rally, expect the dollar to rally, and expect stocks to continue what they've done over the last couple of weeks, and that's continued to move lower. However, if we get a cool CPI and a cool PPI, expect stocks to retake the gamma flip, consolidate here, and make the next move higher. If we get a consensus CPI and PPI report expect stocks to probably just trade inside this zone right here. So those are your three plays for the week with PPI and CPI. Now, what really matters is the CPI print. The PPI, not so much because that can be a little bit more volatile, but the CPI is the be all and end all. And diving into sentiment, this is Goldman Sachs Equity Sentiment Indicator of Investor Positioning. And this indicator combines 9 measures of positioning across retail, institutional, and foreign investors, and has historically been a statistically significant signal for near-term S&P 500 returns. You can see sentiment has been largely frothy in the last couple of weeks, and for most of 2024 and 2025, we were in stretch positioning. We have seen a pullback ever since that has coincided with the market pulling back. However, we are still not in light positioning like we are right now, and this pretty much tells us that positioning is slightly stronger than what it was 12 months ago in the market. However, if this continues to pull back, that will coincide with the market pulling back. Nonetheless, until we actually get below the zero line, that's when we can start stressing, and we haven't really seen that just yet. For all intensive purposes, the market momentum we're seeing is nothing but a garden variety pullback built on over-interpretation of the macro and fundamental. And talking about the fundamental side of the market, guys, for all intensive purposes, regardless of what happens, if the market hits these earnings expectations for 2025, stocks will do well this year. And that is 13% for the S&P 500, the equal weight, and the S&P 500 mid-caps. That's 21% for the Nasdaq 100 and 44% for the Russell 2000. We hit these figures, stocks will do very, very well. We should see double-digit returns across the board in all indices, and we should actually see outperformance in the Russell 2000. However, if we miss these estimates, things can get very, very ugly very, very quickly. But let's talk about the S&P 500 more specifically and its earnings. And what we've seen in the last 5 quarters is that the S&P 500 has beaten earnings very, very handily. As a result, we've seen earnings expectations rally up. And I do think if history is a guide, we should see a solid Q4 beat above the consensus of 8%, and then we'll go from there. If we actually get a beat above 8%, that will bode very, very well for the market or market momentum. However, based on where valuations are right now, guys, if we actually miss this 8% figure, things will get ugly for the S&P 500. And one headwind for us missing earnings could be a strong dollar. Looking at this regression model, where fewer companies actually report revenue beats when the dollar appreciates. The US dollar has been very strong, and in Q4 earnings season, you are going to see every CEO and his management team use the words constant currency. The buzzword in every earnings report prior to this was AI. The buzzword in Q4 is going to be constant currency or FX neutral. Now, a big headwind to earnings is the US dollar, I get it. But the bigger headwind or tailwind is actually the macro. And right now, the macro looks very favorable. Guys, we got a solid payroll figure in the NFP last week, blew past expectations. There was a lot of market volatility because rate cuts simply got pushed back from March into June. And having digested the entire non-farm payroll report this past weekend, this is what I got from it, okay? This is a good job market if you're happy with your job, as wage growth is relatively strong and the probability of getting laid off is low. We saw that in the JOLTS data. It's not a great job market if you have a job but are looking for opportunities, and it's a tough job market if you don't have a job and are looking for one. Nonetheless, the labor market is resilient, and especially wage growth. When you look at stuff like federal employment tax receipts, employee compensation, and disposable income is super solid right now, up 15.2% for the month of January. And I think this is part of the stuff that the Fed are looking at, and that could potentially re-accelerate inflation in the future. And that is why we're actually seeing certain banks, certain investment firms move the conversation from cuts into hikes. Based on the December jobs report, both actually think the cutting cycle is over and inflation is stuck above target with upside risk. I actually somewhat disagree with this purely on the back of the data we're actually seeing right now in rent growth. These sheltered figures, particularly rent, is coming down significantly. We are actually seeing rent deflation across the US, huge in Texas, and 7.2% rent deflation here in Austin, this is going to start making its way into the housing data. This is the component of CPI. 44.6% of CPI is housing. I think we are going to see a massive deceleration in inflation in this CPI report, and that's going to be on the back of shelter, and that is going to continue to see inflation tick down, and it is going to give the Fed the power to cut 2 more times this year. We just have to wait for this housing data to make its way into the CPI index, and it all starts this week with CPI on Wednesday and PPI tomorrow. However, when we look at what the bond market is telling us, bond yields rising like they are is not entirely a mystery. In fact, it's consistent with a short rate cutting cycle. Essentially, the bond market believes the Fed is basically done with rate cuts, and if you're with me on the fact that we actually are going to see shelter data and rent inflation data materialize into the inflation reports to give the Fed the power to cut rates, you're essentially saying the market is wrong. That's what I believe is going to happen. It's risky to go against the market, but I truly think the market is wrong. With regards to the rate cut situation, I think in the back end of the year, we're going to see yields come down in a very significant way on the back of inflation ticking down in a very significant way. And that's going to give equities the firepower to keep rallying. So guys, we're looking for a dip year in Q1. Embrace the volatility, be a contrarian. This is where real investors are made. Now let's actually look at earnings for this week, guys. Now, Monday, we don't really have much. KB Home, that's about it. Maybe a barometer for the housing market, and AEHR Test Systems. Then we don't really have much on Tuesday. And then we do kick things off on Wednesday with JP Morgan Chase, Citi, BlackRock, Wells Fargo, Goldman, BNY Mellon, all of the banks reporting before the open on Wednesday. Then we have Concentrix after the close. That's pretty much it. We'll talk about all of the other companies in the later videos. And then looking at earnings. Now, tomorrow, guys, we actually get the PPI. The consensus, the forecast there is 4.2. The previous figure was 0.4. Now, we don't actually have the consensus right here. And then on Wednesday, we get the CPI headline and core figures, but we'll tackle that in tomorrow's video. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.